Whoa, my goodness, the Dallas Fed Manufacturing Index has contracted again. And this is not the first time, not the fifth time, not the 15th time. In fact, this is the 21st time consecutively. This is really insane right now. Is this something that we don't know or something has went wrong? Because history has proven when this index has contracted more than 20 months, right, things will get very, very bad. But the thing is this, well, the players are telling us that there are no recession. In fact, it just be a soft landing. So let's go into detail. Let's go. All right, disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now, first of all, let's look at the Tesla first, okay? Now, Tesla came down to 180 2 days ago, and I'm telling everyone around me to buy some Tesla if they really are Tesla fan, because I tell them that it will go up to 195. So that was what I wrote about 4 days ago. I mentioned that this will happen to Tesla. You come to 180, perfect, right? And I say it'll rebound to 195. It happened last night in a way. So the next move will be 154. Yes, indeed. To me, it's all right. I believe that Tesla can't really go back above 200, and likelihood it'll come back down to 178 and trade down to 154. But of course, I can be wrong because the fund manager says that, right? They believe that this SpaceX valuation will triple in 5 years' time. He believes that their fund will do very well, and they basically bought a lot of Tesla. Hence, therefore, they believe that Tesla will become a 500%, runner in the years to come. Well, okay, it's actually done by David Baron and his father, Ron Baron. So my thing is this. Doesn't matter. Everybody got their own view. So if you think that these guys are correct, you can buy more Tesla. For me, I would rather buy Tesla when it hit 154. Now, one thing to note is that the Chinese Plunge Protection Team had came in the market right recently. We covered that the China stock market will recover because the government comes to save the day. Well, the thing is, you can see from the flow is out, the look at it, my goodness, the amount of money they spend is incredible. Nearly $12 billion. But the question is this, can this sustain? The thing is that it seems not able. If you look at the chart right now, the China stock market has returned to selling mode again. Now, I shared this before many times to you. Every time when they try to pump in money in the market, right? The next moment, the market take advantage of this. They try to pump again, the market sells again. They pump again, the market sells again. So it seems that someone is just basically milking these players. And of course, I believe the Chinese know it, but they got no choice. If they allow the market to continue to go lower, this is going to be very bad, right? So that's the reason why I say avoid the Chinese stocks for time being. I know some people calling for buy right now. I don't think it's time to buy now. Leave it alone. There will be more downside. Who knows? We may even see 10,400. It is very possible for the China A50 to see 10,400. It is really, really possible because there are still a lot of things happening. And you can see now the court had ruled that Evergrande has to basically submit for bankruptcy, right? We all can see on the news. And this is not going to be the end because there'll be a lot of repercussion for all the bigger, smaller enterprises dealing with Evergrande. Now, of course, the Dow Jones has been climbing. It's incredible. I woke up this morning, I see, wow, 38,300. Now, to me itself, I mentioned to you guys, 38,000 will be a very good level for you to take some profit. And I don't know, means my word to say that I didn't say that. But the thing is this, if you want to chase it right now, I really don't think so. If you look at it carefully right now, the market is showing a very clear divergence on the RSI versus the Dow Jones. Now, of course, again, if you want to buy right now, because you expect 40,000, 50,000, of course, it's still very cheap, but I'm not going to buy anywhere right now. To me, is that you are just basically buying on a balloon that's going to burst any minute of time. All right. So to me, it's all right. This is not a time to buy. We all know that the Three Stooges have been buying, calling for no worries when inflation was there and things like that. But of course, we all understand that they had to do their job because Biden is going to run for his presidential election. And of course, this Yellen is helping him, and Jerome Powell have no choice in a way. So we just need to understand that. But again, by doing that itself, is it because the economy is doing well? Well, apparently now the dollar has pulled back down. This is something interesting. The dollar, I was expecting the dollar to trade higher. This is the US 10-year yield. I was expecting the yield to go up to 4.4% because I just feel that there'll be no interest rate cuts. But apparently now Goldman Sachs came in and very confidently says that we continue to expect the FOMC to deliver the first cut in March and 5 cuts in total for 2024. Now, for a statement from Goldman Sachs, that means that they must know something that we don't know. So what's the reason? Why are they insisting so many cuts? Is it because they want to bump up the liquidity in the market? Well, it's possible. Based on the global liquidity index, you can see right now that since 2000 until to date, with the cycle, a long-term cycle, which is symmetrical, you can see that the global liquidity seemingly really follow it to the T. So that means that I'm going to have a bull market all the way to 2026, whereby based on some of the calendar, says that will usually be the peak of the market. Well, it is possible. So if let's say now the market really pulls back the next few months, this could be a gigantic opportunity for you to buy from the low again and really hold it all the way to 2026. You understand my point? So this is possible. So that's why I'm not saying that the market will crash and it will not recover. In fact, itself, I really want the market to crash so that you can buy it cheap and then hold it all the way till 2026. Let me know in the comment box your feel. But of course, the main driver is that the current S&P PE ratio is really not cheap. Now, let me explain this to you. Now, take a look here. The current trailing PE now is about 22.2, but the average is 14.8. This is something you must understand, all right? And the thing is this, the Schiller PE, right, is at 30.8 right now, while the average 17.4. Now, this is actually from Bank of America, yeah? And so you must understand that this is really good stuff. And if you look carefully itself, in terms of the ERP market base, we are really at a stretch level. And of course, right now, we are not really coming in terms of dividends versus the yield, right? So all these things tells us that this is really kind of insane if you're telling me you're going to buy a lot right now at this price. And that's the reason why Warren Buffett is not buying. That's the reason why Ray Dalio, they're not buying. Of course, some people say that, no, they're buying something else. But the point is this, do you want to buy it right now? I really don't think so. Because the US dollars federal Fed manufacturing index is really insane. Let's take a look here. So we are entering the 21 months contractionary territory. The last time we have this something of similar sort as well, we entered recession and it happened again and so forth, right? So the thing is this, since December 2005, we have never hit this top level before. And now the thing is this, if this continue, we will have great issue. So that's the reason why Steve Henrich, right, says that if the Dallas manufacturing index is minus 27.4, if it doesn't convince you of a soft landing, nothing will, which is clear. You can't have this ongoing right now and expect to be no recession. This is really insane. So that's the reason why I believe that Goldman Sachs really want a lot of interest rate cuts, because they need to get the market moving in case once they hit the fence, there's liquidity in the market. So if you look into it and the index and the report, you can see right now that the production has fell from 1.2 to minus 15.4. This is really very bad. New orders from minus 10.1 down to 12.5. Shipment basically goes down from minus 5.3 to minus 16.6 and so forth. And the only thing that is good is that the wages in a way still maintaining, but it also fell a little bit. So overall itself is very clear that the whole thing doesn't make sense. There's really contracting factory activities. There's decrease in orders in shipping, worsening business perception, and of course, the input costs rising and selling price being flat. The only good thing is that the wages and benefit continue to rise, with the index slightly increased to 20.8, but still in the line of common average. So if you look at it overall, how can you be not having a recession? The only thing is because the stock market is still at a high, and it's undeniable. Look at the NASDAQ. Now, undeniable, I did mention that NASDAQ is the time to sell. I put it up front here. I believe that it's good time to take some NASDAQ profit. So on that day we called for sell was over here. The next few days, the NASDAQ did come down a little bit, but yesterday, well, basically it covers all the losses. So people are asking me, Kel, what do you think? Do you think I go higher now? Go to 18,000? No, sorry, my bad. I still think that we should see a resistance at about here itself. To me, 17,500 is still going to be the resistance. I don't think that the market can go any more higher than this. Of course, right now it's higher than 17,500, but I think that is where you should stop. You shouldn't be jumping in the market. I think you just let it go, because if you're going to go right in right now, the next pullback can be as much as a 500, 600 point movement. You don't want to be caught at that point. It's better to buy, right? Because look at the tech versus the S&P ratio. You can see that the last time, year 2000, Y2K, we hit an ultimate level of 0.65, and then things went all the way down. The NASDAQ went down more than 50 to 80%, remember. And then after that, we saw the similar thing in 2022. It came at the same level. Can you see that? Incredible, the same level. And again, that's where you stop. But this time around, my goodness, the market has broke above it, which is kind of expected when the market is in bullish condition. And now it's at 0.74. Now, to me, this is really way overboard. Okay, way overboard. I don't know what to pick there, overboard. Okay, so that's the reason why I think that Yadani, which I covered a couple of days ago, I believe that he's right on. I think that it's time to really get out of the market, especially for the technology side. It's sort of like a big bubble going to burst. Because if you remember when you hit Y2K time, when every .com was going up and stuff, everyone around me calling for buy, it was insane. And of course, I get people saying that you are wrong, Kel, blah blah blah. But when the market hit that point and pulls back, you can imagine the cry, the sorrows that everybody went through. So because of that, right, you must understand something here as well. Although Yellen and Powell is doing a great job to maintain the economy, we all know that they're trying their best to have no downside in the market before election. But interesting, someone put it there, the last 3 market crashes happened right before election, year 2020, 2008, and year 2000. It kind of makes sense, right? So it is possible when you're trying so hard and the economy is not doing well, things can get very bad. All right, so hope you like my video. Like, subscribe, and share my video. This is Cal signing off. Take care. Have a great day. Bye-bye.